Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Welcome to the latest edition of Carson's. It's not Facts versus Feelings. It is Facts versus Feelings. We do so many of these. I was thinking take 5. Sorry, we do a lot of these. We took last week off. It's proof. I don't know what's going on, but this is episode 82 of Facts versus Feelings with Ryan and Sonu. Sonu, we're titling this one, Yes, Stocks Can Go Down.
How about that?
Yeah, I mean, who knew? So many people have been spoiled by this big win streak. So we're going to get into that. We're going to really dive into kind of what's going on in the equity landscape. I think there's a lot of interesting things taking place right now. Will we have a 10% correction? Will we not? Will we have a bear market? Will we not? We'll give our opinions there. Then just do it with macro backdrop. And we've got inflation data coming up. The Fed is always out there. We've had some continued strong economic data. We're going to dive into all of that. But Soto, before we get into that, a week ago, you and I were in New York City. That's why we did. We had the recorded version last week with Dan Ives. Hopefully, you've had a chance to listen to that. That was an amazing discussion with Dan Ives. Talking about AI and the future and technology and all the cool stuff that Dan does. But we were
still recovering from our New York.
Beat you up a little bit, doesn't it? But you and I were checking in, and all of a sudden the guy looked at you and he goes, "You didn't know this was coming, but you figured I'd pick on you for it." He goes, "Sir, you don't have a room." And I'm in the one next to him. I'm like, tell me he's not sleeping in my same room with me. I mean, it'd be okay. It wouldn't be the end of the world, but like, let's get the guy a room.
Or something.
Yeah, So take it away, Sonu. What exactly take note? Sonu is like the smartest guy on our team. He's literally he graduated.
Not.
He graduated from Purdue with like a rocket. He's like a rocket scientist. But when it comes to booking rooms, Sonu, take it away. How'd that go?
So here we are. Here's the story.
Hear me out.
Right?
Yeah.
April 14th, 15th is supposed to be in New York. I'm supposed to be booked from 14th to 16th. And of course, I booked my tickets, and at least I got the airfare right, and Ryan.
That's true. That's true. You were there. That's true.
I was there. So it turns out, long story short, I booked it for March 14th to 16th. So by the time I got there, they were like, "No, you don't. You don't have a room." I was like, "I'm sure I have a room. I'm looking at the confirmation, and all I'm focused on is 14th to 16th, right? It's not registering that it's March. And then I look again, it's like, it was March. And like, wait a minute, did you guys charge me for that? And it turns out they did. They charged me for that room.
Whatever happened with that? Did you get your money back? Okay.
Not yet. That's between me and Jessica, I suppose.
Okay. Gotcha. All right.
Maybe she can listen to the pod and she'll have some sympathy for my.
I don't know. I don't know if I would. I don't know.
So I screwed up. Speaking of that, I also screwed up our vacation, our summer vacation. We traveled. We're supposed to travel July 23rd, and I messed up, and we're traveling on July 24th now.
So Sonu can do a lot of things, but let's just say booking flights and travel you can do it, but it might not be your strong point. We'll just leave it at that. But let's dive in again to episode 82 of Facts versus Feelings. Yes, stocks can go down. So Sonu, after I guess October 27th to March 28th, about 5 months approximately there, S&P gained over, I think it's 27.6% on a price return. The last 12 months, it's almost gained 30%, or over 30% on a total return basis. But
and just to be clear, 30% in 12 months is not normal. Right?
Or 27% in 5 is not so normal either. Now, believe me, we've had the geopolitical concerns. We've got, is the Fed not going to hike as much? Is the economy overheating? I mean, we've talked about all these things. We're getting into more here in the next 40 minutes or so. But the bottom line is now we've had a 5.5% correction on the S&P. We had a 6-day losing streak last week. Every day last week felt like the market opened up and then closed lower, because it did. Like the let's see, it's Tuesday, Wednesday, and Thursday we saw there. Monday, Tuesday, Wednesday, Thursday, opened higher, closed lower. The bears were in control. We did pop yesterday on Monday. We record this on Tuesday. How worried are you that we've had the first mild pullback? And do you think it's going to get a lot worse, a little worse? Are we close to a low? Let's start with that conversation.
I think anytime you think about pullbacks, the easy thing to say, and this is true, right? I'm I'm looking at your table here. Pullbacks are normal, right?
Yeah.
Whether it's 3% pullbacks, 5%, even 10% pullbacks are normal. It's just that we haven't seen it in a while. We've been so acclimatized to the market just going up, right? And then there's been like, oh yeah, if it's down a little bit, if it's down 1%, everyone comes in and buys, right? So sentiment has been getting stronger. You've talked about that. I've talked about this. But sometimes you need a little bit of a shakeup. And, just to put some numbers around this, right? So the market is up maybe, let's say about 10%, just to make the math easy, right? Towards the end of March, year to date, 3 months, it was up about 10%. So you can break S&P 500 returns down into, how much of those returns come from earnings growth, how much comes from valuation, multiple growth, right? And that's basically sentiment, how good people are feeling about, future earnings, things like that, and then how much they want to pay for that. So earnings growth was contributing about 3% to the headline return of 10%. And then multiple growth is contributing about 7 percentage points. So 7 plus 3, that's how you get to 10. Now you fast forward to, 3 weeks later, here we are. Earnings season has started. The good news is forward earnings expectations are still rising. So there's no breakdown in the economy, nothing like that, right? Companies are not saying that, oh no, we think profits are going to be lower. Nothing. They're not saying anything like that. Profit expectations are going up. So now the S&P 500 is up just over 4% year to date. So it's pulled back from 10. There's a bit of a correction there. And earnings are contributing most of it. Earnings growth is contributing about 3.5 percentage points to that 4% year to date return. And valuations have pulled back all the way. Now it's contributing just 0.5%. Over the long term, it's earnings growth that matters. It's profit growth that matters. So the pullback, in a way, is like valuations have pulled back. Sentiment has pulled back, right? Some of that euphoria has pulled back. So that's the way I look at it. Maybe, you could call that healthy, Ryan. I don't know. What do you think?
Yeah, I think so. I mean, we've on this very podcast well over a month ago, we're talking about how there's no other bears out there. Everybody's bullish. The long-term bears are now bulls. We were saying, listen, there could be a little bit of a rug pull, massive rug pull. No, the economy's still strong, but something to shake the tree a little bit. And clearly, that is what we've been seeing with the approximate 5.5% mild pullback on the S&P.
I like the image of you going and shaking the tree and getting all the bears coming.
Yeah, there's bears up there. I'm getting them down. Come on, bears, get down. Yeah, they were on the train with us a month ago, and I was worried. I told you, I was looking around like bears literally are making fun of you and I on Twitter a year ago right now, telling us about yield curves and LEIs and hope and how's I didn't even understand what they were talking about. They're making fun of us, and I'm like, whoa, they're on the same train as we are now. So sure enough, this little pullback took place. But anyway, what was interesting also about last week, Sonu, yes, the S&P was down over 3%, the worst week on the year. We were down like every day last week. If you looked under the surface, there are actually some improvements. Scott Brown, big fan of Scott over at Brown Insights. He noted, if you look at the number of stocks, the S&P making a monthly low on a percentage basis, it peaked on Tuesday last week. So every day, less and less stocks are making a monthly low. Yet, as we know, price was going down. We call that a positive divergence. And a lot of that had to do, of course, with technology really taking on the chin, specifically on Friday. I want to dig in on Friday for a second here. NVIDIA down 10%. Some of the high flyers just crushed on Friday. Yet a lot of sectors are actually higher on the day. 330 some stocks in the S&P were higher on Friday. Yet the S&P was down 1%. So no, I got data back to 98 on this. Only once, October 20, did I find a day where the stock market's down about 1%. Yet more than 300 components of the S&P were higher. Keep it simple. Normally, when 330 stocks are higher, you have a green day like Green Day, like the band. You have a day, a day that is green majority of the time. That wasn't the case again. So under the surface, there was actually some improvement. One more, Frank Capillari. We've had Frank on before on where were we? I guess Excel last year, which we're going to talk about Excel here in a little bit. Frank did a cool chart. Just look at the equal weight S&P 500. The last 4 days last week, it went sideways. I'm not saying sideways is great, but I'm saying if you looked at the S&P, it was cracking down, breaking down. So again, what did Scott show? What did Frank show? What are some of the things I just cited? Under the surface, we were seeing improvement that you would never know because tech is masking it. So now my question to you, I mean, hey, it is what it is. Tech is a big area. Tech can probably go sideways, maybe even go down a little bit, but we can't have tech crashing like it was because the overall indices will go down. What's your take on tech and how much it truly matters here? And will it rotate to other areas? I guess is a good question too.
I mean, I'll preface this by saying that we've been neutral on tech.
Yep.
For a long time. I mean, since, more than a year now, we've been neutral on tech. And you could argue, oh, you guys missed the NVIDIA thing. I mean, for one thing, look, we are looking top down. We still are overweight equities, which means we are going to be overweight all these things, right? Because we have the S&P 500 in our portfolios, and the S&P 500 is a market cap weighted index. That means most of it is concentrated in Apple, Microsoft, Nvidia, Amazon, Google, Meta, right? And those are your tech stocks. Yeah, like you and I have talked about last year when the market is going up on the back of these stocks. We're like, yeah, you want your winners to do well. Yeah. You want those stocks to do well. Now we've got kind of the opposite situation. Apple struggled a bit. Tesla struggled a lot. And it looks like Nvidia is that some of that euphoria we just talked about, that's coming off Nvidia as well. It was down a lot last week, right? And again, none of this is a recommendation or anything like that to invest in these stocks. I just want to make it clear. We look at things asset allocation wise. But no, I think the story this year, if you ask a lot of investors, has been about AI and tech and Nvidia. And remember Nvidia's earnings, right? There were big expectations going into February earnings, and they beat that. Right.
Oh, yeah.
But now you look at the tech sector. If you look at the Spider XLK ETF, it's up about under 3% for the year. It's underperforming the S&P 500. I bet most people would not think about it in that way, right? Like industrials are doing better, financials are doing better, energy is doing better, materials are doing better. All of these are the cyclical parts of the stock market, cyclical parts of the economy. That tells you something. Sometimes, look, I look at the macro data, and I come up with a story there and say, okay, this is how we should maybe invest based on the macro data. But you always want to pay attention to the markets. What is the market telling us, right? Market's telling us the economic backdrop, it looks pretty good.
And we've been saying that for a while, right? In the models that we run for our Carson partners, maybe almost a month ago at this point, Sonu, right? We added a little more equities. We added some industrial, some financials. I mean, just a little bit. We saw some opportunity because those are the areas we like. And is there going to be this big rotation from tech to those areas? Maybe. It very well could be. Again, why are we more neutral tech? And again, we were overweight equities. So it's not like we didn't like tech. I just looked at tech like it had this enormous run. The rubber band was stretched. You talk about the market, the stock market. Stock market's pricey. Yeah, there are parts of the market's pricey because tech's really pricey, especially start of the year. Yeah. And sure enough, things have come back, whereas other areas are a little cheaper. One other cool thing, and I'm going to go by memory here. Josh Schaefer, we had lunch with Josh in New York last week. Yahoo Finance, big fan of Josh. He had a cool chart just this morning that showed like the 5 largest companies, the 5 big tech names, is what I should say. And then you look at the other 495 earnings growth. Yes, massive earnings growth for those big 5 tech names that we all know and love until the fourth quarter. Around the fourth quarter this year, the other 495 are supposed to grow year over year like 18% or so, and those big 5 about 19. So the rest of the market's catching up. And you might say, well, okay, big deal. That's the end of the year. Trust me, the market knows what's happening now. It's always what's forecasting later. And so I think one of
market's looking forward. Right?
Yeah, one of my views is probably a better way to put this, that the rest of the market is going to catch up and maybe even be more than those big stocks by the time we get to the fourth quarter. Because again, I mean, energy's like been a huge winner this earnings season. I know it's a real small part of the S&P 500. I get it. So it's like minimal, but there are some other areas that really could have a lot of earnings growth if this economy continues to be strong. Anything else you want to add on any of that? I got a couple other things to talk about. Would you add anything else there?
I mean, I'll just go back to the point about for our portfolios, when you say we're neutral tech, if you break down the sectors for our portfolios, tech is still the largest piece of it.
Yeah, it's true. Yeah.
Right. So being neutral just says, I don't want to be even more overweight to tech than it already is in the basket. That's all we're saying. Right. Yeah. We don't need to be overly optimistic about tech here.
Yeah. And there is, let's be honest, there is some career risk there. If you go wildly underweight tech and you're wrong, well, that's not good when you're managing real money. So we're comfortable being neutral, and it's exactly. It makes sense to look at things like that. So again, we've had a 3-week losing streak. We had this big win streak. We just started the pop on Monday, little follow through on Tuesday. We'll see by the time this all goes. But I mean, let's go this route. Most years on average have a 10% correction. Last year had a 10% correction. You look at the last 44 years, going back to intraday data, peak to trough data, last 44 years, back to 1980. 23 of them saw a 10% correction. I mean, it's at least one 10% correction. A lot of them have a lot more, but 13 of those years, stocks still finished higher, including last year. And the average return those 13 years, Sonu, over 17%. So a lot of numbers I just threw at you there. You can have 10% pullback, correction, whatever you call it, and stocks can do just fine. Last year, the perfect example. Now, here's my particular case. Let's talk about market sentiment. I don't think we're going to get to 10% on this one. I mean, I know we're getting close. I get it. We're not even close. We're halfway there. 5.5%, little pop. I look at some sentiment things. The VIX was up around 20 on Friday. We had massive fear on Friday morning, Thursday
night. And the VIX measures how fearful people are.
Exactly. The fear gauge will keep it simple, but you can look at the spot VIX versus the VIX futures. Keep this real simple. We're seeing as much fear just on Friday as we saw March of last year, because again, it's kind of apples to apples when you look at it that way. Keep it simple. But there's a lot of fear. The NAAIM, which I've only spoke for
You asked
before.
me.
Yeah, let's
this
see.
before.
National Association
Of-
Active Investment Managers. I hope that's right,
I hope
guys.
it's-
I'm pretty
yes.
sure. Big fan of that. They're showing some people are getting worried, right? Rightfully so. Look at fund flows. The last 2 weeks, we've seen enormous U.S. equity fund outflows, like the most we've seen since some major lows before. It doesn't mean we're at the low, but I think we're in the neighborhood. I wouldn't be shocked if we made maybe one more little whoosh lower, but saw positive divergences internally with more stocks participating in the upside versus down. And just a couple more comments, and I'd love to get your opinion. If you look at just seasonality, which I know seasonality is not perfect, but it's a roadmap, I wouldn't ignore it. In election years, you tend to bottom, have a choppiness to a low late May, and then a surprise summer rally. I guess I'm going to say surprise because most people think, oh, sell May, go away. We'll talk about that soon. It's not necessarily true. But election years, you get a summer rally. And election years that are up a lot the first quarter, like this one. I looked at just up 5% the first quarter, only like 4 or 5 years. You get a good size give back from now until the middle of June. So again, little dicey-ish now for the next month and a half or so. But let's be honest, maybe we just consolidate. Maybe we just chop around and frustrate the Bulls and the Bears after this run, which would be perfectly normal. So as of now, I'm not so sure we're going to get a 10% correction. I think we're down. One more comment. 4,800 on the S&P. A lot of support there. Why? That was the peak back in 2000. Remember that major peak we had in early January 3rd, I think, 2022. Sorry, 22. The 2022. The peak the very first day, new all-time high, then everything fell apart, obviously, after that. But the previous resistance should be support. If we were to pull back around 4,800, that'd be I tell you, if you have someone out there saying, oh, I missed this rally, or advisors listening, when should I add some from some clients that maybe missed some? I mean, if we get to 4,800, that to me would be a pretty nice area. And it very well could happen. That'd be about, I think, 8.5% peak to trough, which would be perfectly normal, especially after the run we've had. All right, so I'll shut up for a minute. What do you think? 10% correction, 5%? Anything you want to add to what I just said before we move forward?
I won't get myself in trouble, but I have a question, actually. While I was thinking about this as you were
You can get yourself in trouble. Nobody's listening. No. just our friends. It's all right.
But you mentioned Scott Brown, and I know we're going to speak with him soon, so I'm really excited about that. But some work you did, Scott did as well. Like April's historically been a strong month for markets. Would it worry you if we are down in April?
Yeah, so Scott, and again, I have done it in front of me, but Scott pointed out, and I'll do this data too, when you're down in April, you tend to have a little more weakness over the coming months, because April is what? Normally bullish, right? I think that's it. Right, I mean, usually it's like the strongest month on average, and at least the last 20 years, and even since 1950. I think November is the first, but April's right around there. So there's a few ways to look at this. If that's all you looked at in the vacuums, oh boy, this month should have been up. Now it's not. Now the month's not over. Now I get it. We're probably still going to be having down April, all things considered. Historically, the second half of April is a little bit better than the first half. So we'll see that could play out again. But I'm not overly concerned, again, because I knew what was happening coming into it, right? A 5-month win streak coming into it. Historically, and I've got this here. Let me look. When you have a 5-month win streak end, like it's probably going to, Sonu, we've had a lot of 6-month win streaks, 7-month win streaks. I think 12 might be the all-time record. Don't quote me there. But we've had some long monthly win streaks. When you have a 5-month win streak end, the next 3 months to 6 months are kind of not so kind of choppy, not all that great. It makes sense, but a year later, higher 6 out of 6 times, up over 10% on average. Again, that's kind of those themes that we've talked about, these big breadth of strength that we've seen,
and momentum plays out over the long term.
Exactly. It plays out in the long term. You catch your breath. It kind of makes sense. So, I'll dive more into the whole sell May go away thing very soon. But sell May go away hasn't worked lately, and the fact that we came into April so historically overstretched in a near term, it kind of made sense that we might give some back eventually. And sure enough, it's happened in April.
I have a bit of a working thesis. I mean, since you mentioned, the first half of April is weak, second half tends to be strong historically. I was wondering, like, what happens in the middle of April? And I could be totally off, right? I have no idea. I haven't tested this sort of thing. April 15th is tax day, right? If the previous year is really strong, what happens in tax day? A lot of people have to pay capital gains. That drains money, liquidity out of the market, right? In a way. Right. I have no idea if this is right. This is purely speculation. But it'll be interesting. Like last year, 2022 was a down year. And then 2023, we saw that, April was fairly strong, but maybe, people didn't have to pay capital gains, right? They could write off capital losses from the previous year from tax loss harvesting, things like that. I have no idea. I'm just speculating, but just a thought.
Well, no, you're right. And you think about Josh Brown, Ritholtz has mentioned this before. Like, if someone's got a lot of cap gains, well, probably they did well. They're going to sell in March, maybe the first half of April to pay for some taxes. You think about 2021, great year. Well, March of 22 was terrible. Now, the terrible war in Ukraine took place, obviously. 23 was a big rally. We know that. And then,
and this year.
And this year we've hit a little bit of indigestion. So listen, is it ever that simple? Probably not. But I think there's something to that for sure, potentially. A couple other things here. We did violate the 50-day moving average. We were above the 50-day moving average on S&P for almost 5 months. Okay, so I looked at 100 trading days above, which is a long time above the 50-day. But
that sounds very violent when you say we violated the 50-day.
Well, it's not meant to be. That's where I'm going with it. Maybe like any good showman, I'm hyping it up a little bit. But when you, after 100 days above trading days, and you finally go below, violate, close beneath the 50-day, 3 months later, listen to this one, S&P is up 14 out of 16 times, up almost 5% on average. And 6 months later, up 13 out of 16 times, up about 7% on average. So again, not super concerning. And eventually you're going to close beneath the 50-day. It's just kind of how things work. So again, when you look at these long cycles above, it tends to say the upward trajectory, at least strength, makes sense. My take, maybe we chop around a little bit more and we'll have a summer rally, maybe a little weakness into late May. Kind of makes some sense. All right, Sonu, we've covered a lot. What time? You've got, 15 minutes?
About 15 minutes, yeah.
15 minutes,
yeah.
Okay. That's that's good. So we'll call this the halfway point. We'll talk about macro and things in a minute here. I did mention Excel a second ago. We're going to give a little plug for Excel. So first off, Excel is our really big conference. It's open to everyone. If you're a financial advisor, you're interested in learning more, please check it out. It is a lot of fun. It's going to be down in Orlando, the House of Mouse down there. We're not necessarily at Disney, but we're in Orlando. It starts April 12th, goes to April. Wow, I'm way off. September 9th. Yes. April 12th. Is that when you try to book a room? September 12th? Is that what I'm thinking about?
Don't remind me.
Sorry. September 9th through September 11th. And you can learn a lot more about it at excelconference.com. That is EXCELL conference. Excel is EXCELL conference.com. Sonu and I will be there. The whole team will be there. Everyone from Carson will be there. Lots of big speakers. We're doing another big event just a few weeks in Omaha just for our partners called Partners Summit. We're interviewing Professor Siegel, right? Like we're going to have him on our podcast live. We're interviewing him. So that's going to be awesome. But I don't know exactly who the guest will be, but there's a very good chance we will do Facts versus Feelings live from there with a really big name. We're looking forward to it. So definitely check that out in September. That. Yeah, it's going to be, it's always fun. Orlando's going to be fun to check it out and hang out with a bunch of people, hang out with their friends and learn a lot more. And we're excited. In a couple of weeks, we go to Omaha to do something similar for Partners Summit. And there will be some more coming there.
Professor Siegel. We're going to talk to Jeremy Schwartz as well, who's been a great partner. And then Bert White, too. CEO
and I wanted to bring that up. We had some big news in the Carson world. We're allowed to talk about it because it's extremely public at this point. But Bert White, we always joked about what his title was. It didn't make sense. His title, he was doing a lot of things. He was the chief strategy officer for a while, but Bert was just named the CEO maybe 2 weeks ago, give or take. 2 weeks ago or so. So Ron Carson, our founder, was the CEO. Now Ron Carson is chairman of the board, and Bert is CEO. So it's really, really cool. So we're really pumped that we're going to have Bert on this very podcast sometime over the coming weeks to talk about, his role at Carson, how he sees Carson growing, and how he sees Carson helping this industry, helping financial advisors. And if you're remotely interested in learning a little bit more, please reach out if you're a financial advisor. But Bert's going to talk about some of those things. So congrats to Bert.
And if I'm right, that one will be live streamed, the one with Bert.
That's true. Yeah, it'll be live streamed.
But definitely check it out.
More coming.
Yeah, more to come there.
More coming there, but that'll be in a couple weeks. And Bert's awesome. So congrats again to Bert and Ron.
Yes,
and Carson in general. Really, really cool stuff. All right, so we'll call that the midway point. Let's talk macro. This is your world, Sonu. I don't know. Where do you want to start? Where do you want to start with macro? What do you want to do?
Let's connect it to what we were just talking about, equities, right? Equities have had a rough run over the last 3 weeks. We all know that. It's pulled back from being 10% up for the year down to about 4%, right? Through the end of last week. One thing you connected, let's look at what the bond market is saying. right? And
Mm-hmm.
so that's still staying within markets. But once you talk about bonds, you talk about the macroeconomic backdrop as well. Yields have been rising all year, right? We got firmer inflation numbers. We got strong economic data. Payroll growth has actually been accelerating in the first quarter relative to what we saw in the fourth quarter of last year. But what happened? Yields really surged over the last 3 weeks, right?
Yep.
The yield curve, which shows short-term rates relative to long-term rates. Long-term rates have gone up more than short-term rates, which means the curve has become less inverted, right? Now the 10-year Treasury yield was up 40 basis points over the last 3 weeks to about 460, right? 4.6%. It's that more than half of the move over year to date has come in the last 3 weeks,
Wow.
right? Now you look at that and say, okay, market's just pricing in more inflation. Straightforward, right? If there's more inflation, of course you want more yield from the person you're lending money to, right? In this case, that's the government, right? You say, you know what, I can't charge you 4% anymore. We think inflation's going to be higher. I'm going to ask you for 460 instead. That's essentially what's happening. But we also have something called real rates, right? Real rates have surged. Real rates basically are the yields you get on Treasury inflation protected securities. It's an easy way to think about it. The difference between nominal rates and real rates is what markets expect inflation to be. Now, here's the interesting thing. Real rates have also surged. The 10-year real yield, right, is up 33 basis points, 0.33% to about 220, right? So inflation expectations, basically, all that said, like nominal yields have gone up, real yields have gone up. That means inflation expectations haven't increased a lot. It's consistent with 2% inflation, which is the Fed's target, right? What is happening is it looks like the bond market's just pricing in stronger economic growth in the future. If you have a stronger, more productive economy that's running close to capacity, you're going to get more inflationary pressures, from one sector or the other, right? Temporarily, there may be shortages, whatever. So because of that, the Fed's got to keep rates higher for much, much, much longer. It's interesting when everyone talks about, rates are going to be higher for longer. That conversation mostly is around 2024, right? Or rates are going to be higher for 2024, right? But I think this is actually about what we're going to see in 28, 29, and all of those further out years. Rates are going to be much higher because we have a stronger, more productive economy, as I said, that's got more inflationary pressures. And that's what, like I said, this is really what markets seem to be expecting looking much further out, right?
So let me just jump in there for a second. Very interesting. So if you saw nominal yields going higher, but real yields breaking down, going lower, would that be a warning sign to you that the bond market's more worried about inflation now?
Yes, it's more worried about inflation. Anytime real yields are going down, like just first order approximation, this is all, my first look at these things, right? I mean, there's always a lot going on under the surface.
Sure.
But if real yields are going down, I'd say, okay, maybe economic growth expectations are easing a little bit. What were real yields doing over the last decade? It was negative.
Right.
And we had horrible growth. We didn't have very good growth. We didn't have strong growth. That's the opposite. Real yields are expected to be about 2% now. That's hot, right? By the way, the Fed thinks real yields, they're long-term, what they call neutral real yields, right? This means the neutral interest rate, they maintain rate policy at, the market's not too hot, or the economy is not too hot, not too cold, right? So things are perfect. They think real yields should be about 0.5%. And the market's now saying, no. It should be much higher than that because you guys are much more pessimistic about the economy than we are.
Shocking. Yeah.
So it's just interesting to think of, like, over the short term, yes, the market's gotten really pessimistic about, rate cut expectations. But here's the thing, right? Rate cut expectations for 2024, at the beginning of the year, you and I have talked about this. Markets are expecting 6 to 7 rate cuts, 1.5 to 1.75% worth of cuts in 2024. They reprice that a lot, right? By the end of March, we were down to like 3 cuts. Equities still did well. Equities rallied in the first quarter, as we know, right? Up more than 10%, right? And that was because long-term rates were kind of, meandering around about 4%, something like that, right? But what happened in the last 3 weeks is suddenly markets started thinking about, wait a minute, rates are going to be much higher for much longer. I think that's what long-term yields went up really fast. And, I think that's what hit the equity markets and valuations. We talked about that.
So let's talk about some of the data then. I know last week we had retail sales was strong, industrial
Mhm.
production was strong. I mean, you dug into both of those. What did you find? Was that kind of why we saw stronger yields because of those areas,
I
or
I
what
think
else you want to talk about?
that's a part of it. That's a big part of it, right? And of course, inflation numbers came out to CPI,
That's
PPI
true.
too.
True.
There was that too. But stronger retail sales. I mean, I'm shocked how strong it is. I mean, we've all been talking about goods consumption, spending on goods, right? Was strong after the pandemic. Why? Because most of us sitting at home, right? And there's been a sense that okay, that's going to normalize over the next 2-3 years. Here's the thing: it hasn't happened yet, right? Goods consumption is still running
Right.
strong. In March, it was up 0.7% month over month. That's, by the way, that's very strong, right? And expectations were for a 0.4% increase. On top of that, February and January sales were revised up. Sales were up more than 3% at an annualized pace in the first quarter. Most of the strength
Mm,
is actually coming due to online sales, right? That counts. It was up just under 3%, Ryan, month over month in March.
mm.
You take all the volatile stuff out of retail sales. You take out autos, you take gas stations, tobacco, restaurant sales, things like that. What we call the control group, core retail sales, that was up 5.5% annualized pace in the first quarter. That's
Yeah,
strong. I mean,
that's
that,
strong. Yeah.
that's all I can say. We're going to get GDP numbers this week. I think it's on Thursday. Yeah, it's on Thursday. This
Yep.
podcast will be out on Wednesday. But nominal GDP without adjusting for inflation, that's running at 5 to 6%. That's
Wow.
what the retail sales numbers tell us, right? Guess where profits come from? Profits come from nominal GDP growth. If nominal GDP growth is running about 5 to 6%, no, profits are not going down. Now, I can't tell you which sector of the economy, which sector of the S&P 500 will benefit from 5 to 6% GDP
hmm
growth, but we've taken a stab at it in our portfolios. We think the
hmm
cyclical areas will benefit as a function of that.
So a little more. So GDP comes out Thursday. We will break that down next week, but we are looking at likely over 2%. Real GDP growth in
Yeah.
the first quarter. I think it's safe to say nearly everyone expects that, including us. That would be 7 consecutive quarters. Real GDP has been up at least 2%.
It's incredible.
Sony, you have to go back 20 years the last time we saw that. And just
Wow.
think about these last 7 quarters. What have we been pounded on by all those bow tie economists on TV, looking at all the soft data, looking at all the things that weren't working that we talked about daily, said, listen, they're looking at the wrong thing. They're looking at the wrong thing. Hey, it is what it is. You can follow who you want to follow. Hopefully you've learned a lot. But the last 7 quarters, they've been wrong. And we've had some of the best growth we've seen in a very, very long time. I mean, I don't know where I'm going with this conversation other than just it's fascinating to me how incredibly wrong so many of the bow tie economists have been.
I mean, just gets to the underlying point is the economy is being underestimated.
Yeah.
And if the economy is being underestimated, my guess is profits are being underestimated too, or profit growth, I should say.
Yeah.
If economic growth is being underestimated, that's where I would underline what you said.
Yeah, I mean, the first quarter, what we saw forward, 12-month S&P 500 guidance or earnings estimates up like 3%. Okay, what in the world does that mean? That's a huge move. That's a very big move. All of 2019, which was a really good year, forward estimates only went up 2% the full year. We saw 3% just in the first quarter, right? So, and I know forward estimates continue to trickle higher. We'll see. We got some big names coming out, and we'll see what happens from there. But I'm with you there that with the strong productivity we've been seeing, we don't need to talk too much about that. We've talked a lot about productivity, but strong productivity, strong consumer, manufacturing. Oh, ISM manufacturing is finally above 50. Now, listen, we were pushing against those soft surveys the whole time, saying, look at the real data, look at industrial production, look at they're building cars, they're building airplanes, people are building things. I mean, real manufacturing output is up like 2% the last 2 years. I'm not saying that's a lot, but if you looked at all those ISM soft data, those 300 purchasing managers, which apparently so many bow tie economists focus on so much for their whole view in the economy, it was always saying manufacturing was doing okay. Now we've got manufacturing maybe doing more than okay the second half of the year, right?
One of these days, I'm going to come here with a bow tie and scare you.
Yeah.
No, I don't.
Run
I don't
the other
even
way.
own one.
Yeah. Yeah, it's like sharks. I say what scares me: sharks, electricity, and bow-tied economists. Those things. And honestly, fixing a toilet. I will tell you what. Every time, like a leaky toilet or something, a running toilet, I am not smart. I'll be first. I'm just not smart enough. You've leveraged YouTube a few times. It's fixed. It's helped me, but I'll tell you, those are things I'm scared of, especially a bow-tie.
I won't even go there. But we're talking about manufacturing.
How much time you have? 5 minutes. You have 5 minutes.
Yeah,
How you doing on time?
I got 5 minutes.
All right, let's do it. Wrap it up in 5. All right.
Manufacturing. Let's talk So we've talked about the consumer. We talked retail sales. The economy's been strong. What you just said? What, 9 quarters in a row?
It'll be 7. It'll be 7 this coming Thursday.
Yeah, if it's about 2%, right? And it's all come on the back of the consumer. Why is the consumer strong? Because the labor market is strong. Income growth is strong. We've talked about that. But now the cyclical part of the economy is coming back. Manufacturing, housing a little bit too. Let's talk manufacturing. We just got industrial production data last week. 3 really good stories within that. Vehicle assemblies, auto manufacturing. Vehicle assemblies are running around 11.7 million at a seasonally adjusted annualized rate per month, right? By the way, that's above where we were in 2019, right? So that's good.
Okay.
Defense production is rising. It's up. It was up 0.9% in March. That's a big number. When you say 0.9% in a month, that's huge, right?
Yeah.
You annualize it, that's like, about 8-9%. So it's really strong, right? And it was the 15th straight month of an increase. Defense production. It's up about 12% year over year.
And just think about what's going on in the world right now. That's probably not going to slow down. Whoever wins the election in November, that's probably not going to slow down.
Exactly.
Yeah.
So you got vehicle assembly, defense production. Third one is something we like to talk about, high-tech manufacturing, right? You've got the AI story, but you got the CHIPS Act, IRA, all of that. High-tech equipment production, you're talking about communication equipment, computers, semiconductor chips, all of that. That was up 14% year over year. By the way, all that is real. It's inflation adjusted in a way because we're looking at volumes when you talk industrial production. High-tech equipment production, Ryan, is up 27% since the end of 2019.
Wow.
That's real. That's actual activity. That's incredible. That's something happening in the economy. I think a lot of people are missing it.
No, you've been talking about that for a long time, and I think it's been right. It's been right. So Sonu, let's great discussion there. Again, this was episode 82 of Facts versus Feelings. Yes, stocks can go down. I did see on just a couple of days ago on April 20th, 2020 was that day that we saw oil down like $40 a barrel, down 300%. Yes. Some of those screenshots were filtering around on social media over the weekend. And I mean, how far we've come right now. Although crude, I think, hit a 3-week low just today as we're talking, because some of the concerns and worries out of the Middle East have come back a little bit. But still, literally probably one of the, I don't know off the top of my head, but the best performing group from that day probably has been energy, right? I mean, it's just kind of a good reminder. Yeah, it's a good reminder that when everyone loves something, maybe I'm not saying run the other way, but at least think about it. And when everyone hates something as an investor, that could be an opportunity. Final thing, Sonu, it's the final Shogun tonight, the season finale. Have you started watching Shogun or not yet?
I was going to start in New York when I was by myself.
Well, you didn't have a room. You didn't know where to watch it.
Yes,
I had to sleep outside.
And then my wife tells me she wants to watch it too. So we're going to watch it together. So
all right. So again, by the time a lot of people listen to this, if you were remotely interested in Shogun, it'll be.
So you liked it, huh?
Oh, I mean, I haven't seen the season finale yet. So many shows are about how do they wrap it up? How do they do it?
Sure.
But yeah, I think it's a pretty cool show. I've enjoyed it. So hopefully, a lot of people, if you haven't checked out Shogun yet, I think there's a lot of, I mean, sure, it's a show. It's got to be entertaining, but so much of it's based on, Japanese feudal history back in Japan in the 1600s. I mean, that's what it's based on, right?
Wow.
And how it really, really was. And just the way, I won't give it too much away, but it's a pretty cool show. A lot of action, a lot of intrigue, love story, drama, all the stuff you know and love.
That's what got my wife interested. If it was just
all
action.
the stuff, all the stuff that happens when Sonu checks into a hotel. You never know what's going to happen when Sonu checks into a hotel. So anyway, with all that, I know, Sonu, you've got somewhere to go. What are you up to? What do you have?
I have to drop the kids to school.
Take the kids. We cannot be. That's what it was. We cannot be late for that. So, all right, everyone. Thank you for joining Sonu and I. One quick thing: help us out by telling us how we're doing. Leave a review, giving us a like, and subscribe if you want to hear the latest to the Facts versus Feelings podcast. We'll see everybody next week. Take care. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.